Right, let's have a look at this illustration then. Remember, the first thing we do when it's an SFP is we do the equity table, and it's S's equity table, and equity, literally anything that's in the equity part of the question. In my simple question so far, there's just been share capital and retained earnings. So I write that down here, share capital, retained earnings. That's fine. Then I have three columns, year end, at acquisition, when we bought it, since acquisition, what we call post-acquisition. And this is just my little working. So at the year end, remember it's S's equity, so I want S's figures here. This will be the year end in the question, so I want S's equity, which is 100 and 2,900. I presume that at acquisition share capital was also 100, but I don't presume that about retained earnings. I need to go looking for it in the question. So H acquired S, 80% of S 4 years ago when S's reserves, well the only reserves of retained earnings, were 800. So I've got that. So I know that post-acquisition then must be 29 minus 8. Post-acquisition must be 21. Now, the book value of S at acquisition was 900. I bring S in at its fair value. And it says the fair value of S's net assets, which is the same as equity, if you remember. Net assets is the same as equity. Then that was 950. So I need to make a 50 adjustment. And I need to know what caused that 50. What was in the books that had a fair value higher of 50? And it says it's due to PPE with an 8-year useful economic life. So PPE, an 8-year useful economic life, so an extra 50 divided by 8. So let's have a look at that. 50 divided by 8. That will give me my depreciation for the year, which is 6.25 per annum, and I acquired it 4 years ago. So my depreciation so far would be the 6.25 times by 4. Okay, so 6.25 times by 4 equals 25. Yeah, so depreciation of 25 times by 4 there, just so you're clear, it's 25, and that means if it was 50 more, then I took off 25 depreciation, I'd be left with 25 at the year end, and I need to go and put, I always put a little star there to remind myself, I need to go put 25 onto S's PPE, which is in their other net assets in my questions. So far so good then, I can now add that down then, so that's now 2,075. I can then get on with my goodwill working then. So goodwill is the fair value of consideration, i.e. what I paid for it. Then the NCI, I need to be careful which one it is, and I get told it's proportionate. So proportionate NCI, and I compare that to the fair value of the net assets acquired, which is the same as the fair value of the equity at acquisition, goodwill always at acquisition, which is 950. Okay. I paid for it, it doesn't say, I need to go to my question. I paid for it 1,000, the investment in S, 1,000. I didn't pay for all of it though, I paid for 80%, so the other 20% belongs to the NCI. So they get 20% of the 950 of the fair value of S's net assets. So 20% of 950, what's that? That's 190, I think. So let me just check that. So 950 times by 0.2, yeah, 190 as I thought, and that would give me goodwill then of 1,190 minus the 950, which gives me 240 goodwill. Okay, no mention of any impairment yet, so I just go put that goodwill. I can start off my group accounts now, and if you remember, investment in S becomes goodwill of 240. My next working is NCI. Remember, I'm going through this quickly. You can stop the video, go back. We're just going to do loads of questions till you find this easy. At acquisition plus post-acquisition minus any impairment, which there isn't any. At acquisition is always really easy. You just take the figure straight from goodwill. The NCI figure from goodwill, 190. Then post-acquisition. Well, NCI is a 20%er, isn't it? We own 80%, so NCI is a 20%er. So the post-acquisition is going to be in there times by 20%. So let me just calculate that. 2,075 times by 0.2 gives me 415. There's been no impairment, so NCI is 415 plus 190, which is 605. So NCI 605 at the year end. I can go put that in now, and that goes to my equity, so I'll just put it in here. NCI 605 goes to equity. Final working is retained earnings. I want all of H, but not all of S. So all of H I get from their balance sheet, 7,900. I don't want all of S though, because I don't own all of S. I want 80% of S, but not all of it. I want it since I bought it, i.e. post-acquisition. So here's the other 80%. The 20% went to NCI, 80% goes to S's retained earnings. So 2,075, put that in my calculator, times by 0.8, and I get 1660. I would take off any impairment if there was any, but there wasn't. So it's just a case of adding that up then, plus 7,900, that equals 9560. So I can put the 9560 now into retained earnings, and I'm pretty much there. So 9560, share capital, if you remember, is always the holding company. And then all we've got to do is add across the other net assets. So all of these added together is 10,025. And then we make sure we've done it right. So 240 plus 10,025 is 10,265. And then we hold our breath and we hope the others come to it. So 100 plus 9560 plus 605 equals, yes, 10,265. We've done it right, okay? Let's have a look at another illustration.